For joining us in this highly anticipated webinar. We have a captivating topic ahead that delves into the fascinating realm of global market dynamics, but also the performance of the Sanlam AI Fund. In a world driven by data and powered by AI, this topic holds immense relevance for all our investors and all our members today. We are very privileged, thank you, Jorge, to have you here with us today. I'm sure most of you have already listened and met Jorge before, and he will guide us through the intricacies of global market dynamics and shed light on the performance of the Sanlam AI Fund. With his extensive knowledge and experience in the financial industry, Jorge, you bring a fourth valuable insight into what will help us navigate the complexities of the global market and understand how the AI is positioned and what have we gone through the past 5 months, year to date, and what can we look forward to. So without further ado, Jorge, I'll hand it over to you. Thank you.
And thank you so much. Appreciate the invitation, and good morning, good afternoon to everyone joining this call. It's a privilege to be here. I think these calls are important, and I think it's a continuation of our previous calls, just to provide an update on our solutions and our investment portfolios, which are very different from what we find in the industry. Our AI, our artificial intelligence-driven portfolios that utilize ETFs. And so what we'll do on this call is provide a performance review and overview of the portfolios so far this year, especially in light of what happened last year, where we saw a very steep decline in the equity, but not only in the equity market, but also in the fixed income markets. And so I think what we discussed in our last call in December is we provided an overview of the markets of last year, and then providing sort of having the benefit of hindsight of what we presented, we can see, okay, what happened in the first 5 months of this year in the general market, and then of the portfolios of the AI portfolios that we have, and then we'll provide some economic data and some overview, and then we can answer some questions. So that's the game plan for the next 25-30 minutes. So with that, I will open the presentation. And then, of course, if anyone has any questions, then we'll have a Q&A session at the end of this call. So in terms of starting off with the AI portfolios, so we have 4 different portfolios, so really 3 different portfolios that we manage, and they're managed according to a risk profile. So we have the Sanlam AI Conservative Portfolio, the Balanced, and the Growth. And what we do is we utilize an industry leader, an entity, a company that provides risk profiles for portfolios, and we model those portfolios. So as you can see, we have the 3 different portfolios: Conservative, Balanced, and Growth. And these portfolios are very different from what we find with other institutions or in the industry in general. So what makes these different? These utilize an artificial intelligence engine solution to provide exposure to the underlying investments. What are the investments that we're utilizing? We're utilizing ETFs. These are large indices that provides broad exposure into the fixed income markets, into the equity markets, and then late last year, or sometime around October, we expanded the investment universe to allow the AI engine to not only allocate and invest in equity and fixed income, but also introduce a commodities or a gold instrument, and also an equity hedge to reduce volatility. So we saw the volatility that we had last year, and so we expanded the portfolios, and I'll cover some of that on this call. So each of the portfolios have a certain latitude of flexibility to move around within these asset classes. And what makes these very different is that these are very tactical. So utilizing the benefit or the AI engine, these allows us to process a lot of information And we're seeing AI across all of our lives with our telephones. And I think recently with some new technologies that have been introduced in the marketplace, we're all talking about how AI is going to improve our lives, how it's going to change our lives, how it's going to improve the things that we do at work, the things that we do with, if with schooling and so forth. But these portfolios utilize this engine. And so we have the flexibility to move around within these asset classes. So as you can see, for example, on the balanced portfolio, the portfolio can move from cash and bonds anywhere between 35 to 60% on a weekly basis, or in equities and commodities anywhere between 40% to 65% on a weekly basis. And I'll show you how that works in a second. So we have these portfolios that have really two objectives. The first objective is try to avoid capital loss, and I'll cover that more at length throughout the presentation. And two, look at the market and determine what is the best possible outcome for the next 7 days. So we're not looking at what's going to happen for the next quarter, for the next 6 months, for the next year. It's just what's going to happen, what's the most probable outcome for the next 7 days. And based on that, the AI engine will allocate into these different in these different instruments. What are the let me pass here. What are the underlying instruments? What are we investing in? We're investing in ETFs. These are industry leader ETFs. An ETF is an electronic traded fund that is really a compilation of many, many investments. And so these ETFs provide broad exposure into the equity markets, into the fixed income markets. And so what we've done is we have 13 ETFs and cash as well to allocate and to make up and to create these portfolios. These ETFs are offered by the largest asset managers in the world, by BlackRock, by Vanguard, and by State Street. Each of these three companies are the largest asset managers. BlackRock and Vanguard manage money in the trillions of dollars. And so we have the benefit to find the best instruments, the best indices from these providers, and then we construct the portfolios. So what the AI is doing, it's finding the best mix, the best combination between equity, between the Standard & Poor's 500, which is the US equity market, between international equities, emerging market equities, and NASDAQ or smaller companies. And then we have exposure also to the fixed income markets as well, and I'll show you how the exposures work. So the strength of the AI is they're very tactical in nature, and they try to optimize the allocation on a weekly basis by positioning this. There's no other solution that we know that sort of has this mechanism. And this allows the portfolios to adjust to market conditions, which we saw last year. Obviously, both equity and fixed income came down. And so in October of last year, we introduced additional indices or additional ETFs to try to mitigate that volatility. And then we'll see some of the performance. So in terms of performance through the end of April, through April 30th, and if we see year to date, we see a really strong bounce back from what we had last year. So the conservative portfolio is up close to 9%. The AI balanced portfolio is a little over 14%. The AI growth portfolio is a little bit over 18%. And the dynamic portfolio is a little almost 11%. Two things I want to point out. The things that I want to point out is each of these, the portfolios are outperforming their relative benchmarks. So these are benchmark. This is what these portfolios are compared to. So in the first instance, it's very good. And then if we see the performance from how these portfolios ended last year, obviously after a very challenging year where we really haven't had a market in over 45 years where both the equities and fixed income decline at the same time. And we haven't seen the magnitude of that decline. But sort of, when we had this call in December, we pointed out that markets tend to recover. They tend to revert back to the mean. And we're witnessing that in the first 4 months of the year. For example, the balanced portfolio is down 20% through the end of last year. It's up already 14%. And then if we show even through last Friday, we even have improved performance. So the balanced portfolio is up almost 17%, and the EI growth is up 22%. So really making up for the performance that we had last year. And so it's the markets have recovered, the AI portfolios have recovered very, very well, but they've recovered well ahead of the marketplace and against these indices. So in that regard, we have, good positive news for our clients. In terms of showing how these portfolios work and how they allocate. So here I have the allocation of the portfolios, and what I did is, instead of showing the 14 different indices or ETFs, I condensed it to how much is in equities, how much are in bonds, how much are in gold, which that's a new ETF that we introduced last year, and the cash allocation. And the cash allocation, we also adjusted this to allow the AI engine to allocate to cash if it sees there's uncertainty or volatility. So use of cash is very, very important because that obviously cushions volatility, preserves capital, and it meets with, rule number one is try to avoid capital loss. So this graphic, what it's explaining is what is the exposure, what is the combination of this portfolio on a weekly basis between equities, which is shaded in blue, bonds, which is shaded in gray. So we have had very little in bonds over the last several months. How much in cash? So significant allocation into cash. And again, that's for preservation of capital, preservation of value, avoid capital loss, and some exposure to gold, right? Gold is a hedge, is an instrument when there is volatility, it tends to hedge out the portfolio. So we can see how the conservative portfolio is done. We can see how the balanced portfolio has done. So again, the maximum exposure that this portfolio can go into is 60%. So you'll see that, for this period, it reached the 60% exposure, and then it complemented with 40% allocated in cash. So having a lot of cash, also, if there's any volatility, that's going to cushion the impact, and then some exposures to gold. And we can see how the AI engine, how tactical it is, right? We can see, for example, in this period, it went to a defensive position where it really lowered the equity exposure to 10%. It increased the gold position to about 10%, and the rest was in cash. And so what makes these different is that they have the ability to change the allocation, to adjust the allocation on a weekly basis from week to week to obviously meet with the investment parameters. So we can see how dynamic this solution is, and again how it mitigates risk. Now the question that we get is this a perfect solution? And nothing is perfect, right? The market many times works on sentiment, on many factors, but what makes these different is, again, it's the ability to adjust to changing market conditions. And then we see obviously in the strong performance that, for example, the balanced portfolio is up through 17% through year to date, which we're in the 5th month of the year, and so we have very, very, very strong performance. And then on the AI growth, the only thing that changes is how much can it go into equities. So it tends to have more equity exposure, right? But it follows the same premise. It follows the same allocations where it can allocate into gold, into cash, into bonds, and it's utilizing all those 14 indices to find the best combination. And the equities is to find the best combination between the Standard & Poor's 500, the U.S. equity market, or emerging markets, or NASDAQ. So it's really finding the best allocation, the best equity component, and then it combines it with cash, bonds, and gold. So this portfolio through the end of through last Friday, it's up 22%. So very strong performance. It's almost made up the decline that we had last year. So it's the importance of staying invested, the importance of not reacting to obviously to volatility that we had last year. And when we track obviously our clients and equity flows, our clients stayed invested. So they participated, unfortunately, on the decline last year, but more importantly, it participated on the recovery that we've had this year so far. So shifting to global market dynamics, I think in terms of what the concerns for from last year and carrying over to this year is interest rates. The Federal Reserve here in the United States continues to increase rates, given where we are with inflation, not only in the U.S., but when we look at the Federal Reserve in the U.S. or all the major central banks, they've been increasing rates. So we're going to talk about inflation. We're going to talk about interest rates. And then we're going to provide some sort of benefit of hindsight when inflation peaks. What do the equity markets tend to do? And we're sort of, we've seen how the equity markets recover given some market dynamics. So, I found this, and this is very interesting. And as we talk about utilizing AI, artificial intelligence, earlier this year, ChatGPT was introduced, which is really the continuation development of artificial intelligence in our lives, right? And we can see how the pace of adoption in these technologies have changed over time. And so we see some eight companies that utilize artificial intelligence and the use of AI. And we see Netflix, for example, that took 3.5 years to reach 1 million users. And I think we all utilize Netflix in our lives. And then we can see how different companies, Facebook, when it launched, it took 10 months to reach 1 million users. Instagram, it took 2.5 months to reach 1 million users. And this ChatGPT solution, if you haven't used it, it's really interesting. It can do many things, but it took only 5 days to reach 1 million users. So the continuation of technology and of AI continues to improve and continues to dominate our industries. So that's kind of an interesting data point. Getting back to interest rates, this graphic shows interest rates from not only from the U.S. perspective, from the U.S. Federal Reserve, but also from the European Central Bank or from the Bank of England and the Bank of Japan. So these are the 4 major central banks in the world, and they dictate monetary policy. Monetary policy is basically the cost of money. And for a very long time, since the correction that we had back in 2008, 2009, we largely had 0 interest rates or very low interest rates, except for a little period here, but we had very low interest rates for a very long time, right? We had the pandemic in 2020, where, they were in the United States, they were raising rates and rates declined in that period. Well, we've seen that rates, the aggressiveness of not only the U.S. Federal Reserve, but all the central banks in raising rates to cope with this global inflation. And this global inflation is really impaired by the supply chains that were impaired because of the pandemic. And so we see this aggressive push on interest rates. Again, this is being borne because of inflation. When we look at what the market expectations, and this graph is showing what are the market expectations for interest rates, again, from these 4 central banks for the next 3 months, 6 months, for the next year, for the next 2 years. And so we're currently here where where interest rates are at 5% in the United States, and we see the different levels. But given where inflation, it appears to have topped off last July or August, and then inflation numbers have continued to decline over the past several months or several quarters. And so the market expects that interest rates will start coming down perhaps in the next 6 months and next year. And this is sort of the consensus in terms of what the market expects interest rates to come down. So the cost of money will decline that is favorable for investing. That's favorable for the equity markets. And we've already seen some of that obviously in the performance that was captured in the AI portfolios. This is called a quilt chart. So this is the performance of the fixed income indices. So we have exposure to many of these indices in our AI portfolios, and we can see the performance from year to year, and it's ranked from best performance to worst performance, right? So again, providing some hindsight in terms of this is only looking at bonds, at the fixed income markets. And one of the things we can see is that last year, everything had a negative return, right? So even U.S. Treasuries, which obviously is a very safe asset, it was down 12% last year, and investment grade bonds were down 15%. So a very difficult year. And then, again, we look at the end of April, we see the recovery in the fixed income markets. But you can see how these asset classes change from time to time. So the importance of, number one, diversification, not putting all your eggs in one basket. And number two, finding the best asset class to be invested in for that specific period. Very important. If we look at the equity markets, right? The equity markets, what we have on the screen, and there's a lot of information on this screen, and I hate to use small print, but I just wanted to show the performance of not only U.S. equities, but if we look at global equities or we look at equity sectors on a year-to-date basis, and this is through the end of April, we see a very strong bounce back from obviously the markets that we had in 2022. So 2022, it didn't matter where you're invested, if you invested in the U.S., global, if you're invested in different sectors. Obviously, we had down performance. Looking at year to date, we have this strong recovery. So markets tend to return back to the mean or to the average, right? So we have very strong pullback, a very strong recovery so far this year. If we look at sort of the 3 previous years prior to 2022, we had very strong numbers. We had very strong performance. And this is where we start having a little difference between where you want to be invested in, right? And this is where, again, the AI solution is looking for the best allocation, for the best index to be allocated. But we see strong performance in 2021, 2020, 2019. We had a negative year in 2018. So investing is, you invest to the medium long term. You always want to have great, strong, positive years, but in those, sometimes you do have some downturns. But if we sort of average it out on a 3-year basis or on a 5-year basis, this is what's important for us, right? That on a 3-year basis, your average return, and you can see it in the column here, based on, for example, I'll just choose the Standard & Poor's, the S&P 500, which is the biggest market per se, has averaged 14% for the last 3 years. So the importance of having exposure to this and what the AI solution does, it provides a tactical allocation. So I think equity market performance, very good so far this year. And then sort of looking at that same quilt chart, but now looking at the equity indices, at the equity sectors, again, looking at the last year, the declines, and then the recovery, the strong pull-up that we've had so far this year, where the growth, large cap growth companies are leading the way with up 15%. So the importance for the AI to find the allocation exposure to these types of companies through these ETFs, it's important to the performance, and they've achieved it so far this year. Last few slides is just provide some, again, looking at when the markets have declined more than 20%, so if we go back in history since 1950, and we look at performance of the equity markets, when we've had a decline of 20%, what follows it? So we look at, after a decline, what happens in the following year, and those are the green bars. What happens 3 years after? This is sort of the dark blue, and what happens 5 years after, which is the orange, the yellow. So we can see, from prior corrections, and this is going back to 1950s, what follows is a recovery, right? So the importance of staying invested throughout pullbacks is very important for, obviously, for capital preservation and capital growth. So, maybe it's the only period that we didn't have a pullback was back in the great financial crisis, 2008, 2009, which took a little longer to recover, right? It took a little longer to recover, to pull out of that market. And then the importance of staying invested, which is critical as well. When we have volatility, investors tend to change their allocations. They tend to move out of the market. And so there's a saying that it's not about, time in market it's not about, it's about not timing the market, right? And not missing out when we have a strong recovery. What's different about the AI portfolios is that it's making the decisions to stay invested or not stay invested, to go to cash or not to go in cash. So it's really utilizing artificial intelligence. And what artificial intelligence is doing is it's doing a lot of math. It's processing a lot of data, right, to find the optimal allocation. So what this chart says is, if you by being fully invested, by being fully, you participate in the recoveries. If you miss the best 5 days, then your performance over time starts to decline, right? So and so oftentimes investors tend to move out of the markets when the markets have declined and they really miss most of the recovery. Then we look at also at empirical data, historical data, and this is going back to 1958, and looking at inflation, right? And so when we look at and then we're just looking at the S&P, or the Standard & Poor's 500, which is the U.S. equity market. When we look at that, and that, sort of when we've had high inflationary periods, these are the high inflationary periods, going back 60 years. And what tends to follow once inflation has peaked is obviously we have positive performance. So once inflation has peaked, what is the average performance? These are the bars shaded in blue. So on average, the markets tend to recover, 9-10%. The following 3 months after inflation has peaked, the following 6 months, or the following year. So the importance, again, once we've seen that inflation has peaked, we've had performance, and then again we have the proof statement that the markets have recovered so far this year. So positive news in that end, that inflation seems to have peaked, and obviously we have positive performance. So I think that's my, I wanted to maintain between 15 to 20 minutes. I think I've exceeded my time. So with that, Anne, if we have any questions, I'll be happy to answer any questions or provide any additional information.
Thank you, Jorge. That was really, really insightful. I do have a few questions that came through before the webinar from some members. I'll just start with the first one. Risk management is crucial in the investment world. How does the Sanlam AI Fund assess and manage risks to ensure the best possible outcomes for investors?
Okay, good question. Let me go back to this slide then, and I can go back and show something, and then I can expand this a little bit more detail. Here, I'll go here. So to your question is, how do we manage risk, right? So what the AI portfolios are doing is, again, it's providing broad exposure to the financial markets, equity, fixed income, cash, and then in bonds, do we want to be invested in short-term treasury bonds, long-term treasury bonds? We want to be in corporate bonds. We want to be in emerging market bonds, right? Is making all those decisions to see what is the best allocation. So again, I think I pointed out what the AI engine and solution is doing is finding the best combination on a weekly basis, between these ETFs, between these indices, right? And so it's saying it's only looking out 7 days, and it's saying, okay, what is the best, what is the most probable outcome for the Standard & Poor's, for the S&P 500? Is it going to go up or is it going to go down in the magnitude, right? That's the first observation. Then the second phase is, okay, the S&P is going to go up. What is the best combination with these other instruments? So risk mitigation is very, very important. because markets tends to change quickly, right? And so the strength of these portfolios is they tend to be very tactical and change the allocation where, we can, so far we have very strong performance versus the benchmark. So these portfolios are built to avoid capital loss and it's not necessarily built to outperform these benchmarks, but it goes with our client's objective, which is try to, avoid losses and make returns. And so, over a 3-year cycle, mid to long term that we invest in, it tends to provide these returns. So thank you for that question.
Thanks, Jorge. What makes it, how do you differentiate yourselves with regards in terms of performance, perhaps, or approach, as opposed to the other AI funds that are out there available on the market? What makes, I guess, the Sanlam AI Fund unique in its way?
Yeah, what makes these unique is twofold. We have a pretty wide set of investments to invest in. Number one. Each of these, and I'll expand on this. For example, when we look at the investment grade corporate bond ETF, right? This is an index that's made up of, it has over 2,100 individual bonds right here represented in this investment. So when we break open and say, well, how many bonds are here? Instead of us trying to identify and pick individual bonds, individual names, what we do is no, let's not do that because that carries some risk. Let's get broad exposure to these indices, right? So the corporate bond index has exposure to over 2,100 companies. The high yield bond index, it has exposure to over 1,800 bonds. 1,800 bonds are included in this ETF, in this index. So it really provides a lot of exposure. So number one, what makes these different is utilizing ETFs, but not only that is the way these are managed. The way these are managed is, again, looking at a very short period, every 7 days, very tactical to find the best allocation and really to calibrate, to find the best mix. Now, I think I mentioned, this is not a perfect solution. Obviously, these were down last year, and we expanded the investments, the universe. We included cash, we included gold now that they can invest in. But with the AI solution, what makes artificial intelligence work is it tries to learn from its mistakes, it tries to learn from those errors, and it tries to improve over time. So you have a mechanism that's trying to improve the outcomes, again, sticking with the main investment objectives to provide those returns. So that's really what makes it very, very different, our solutions, compared to what is available in the marketplace. And really, we really don't see anything that is this tactical in nature.
Thank you, Jorge. Just a question that came through on the Q&A here. I'm just going to read it out loud. What is the Sanlam AI Fund directly related to? The changes in the S&P. Is there any relationship?
So what is the AI fund directly related? So the AI fund, so the Sanlam AI is not it's an AI, it's an ETF portfolio, right? So the fund, the portfolio per se, right, has all these ETFs to invest in. And so what is the relation to the Standard & Poor's? So the question is, what is the exposure to the S&P 500? So again, on a weekly basis, it's saying, okay, is it going to invest in the Standard & Poor's 500, which is obviously the U.S. equity market? And so what the AI is doing, and I'll go into, so what the AI internally, what it's doing, the AI is really computing. It's incorporating over 600 different factors, right? So it's looking at the S&P 500, 600 different ways. And what are those ways? It's different, 600 different mathematical functions, right? It's looking at mathematical tools such as regression analysis or Fibonacci, or it's looking at different the mathematical computations to come up with what is the best outcome for the next 7 days. So each of these, so the AI is looking at each of these indices and is going through this rigorous process of these 600 different factors, right, to measure what's the most probable outcome. And then the second phase is try to find the best combination to provide diversification to meet with the objective of trying to provide the best possible investment outcome, right? So it's very dynamic in nature. So I think that is the question is, what is the relationship? It's a direct relationship where it's looking at not only the Standard & Poor's 500, the S&P 500, but it's looking, you know, at these other equity indices to find the best allocation.
Thank you, Jorge. Thank you. I think I don't have any more question on my side, but I want to thank you for your time. It was very good to speak with you, and let's keep those webinars as we've done previously every quarter. And I just want to say thank you to all the members who joined us today. The recording of this session will also be made available and will be sent afterwards to you. But if you have any questions, as always, don't hesitate to come back either to myself or to Jorge, or I will happily attend to all those questions. Thank you again, Jorge, and thank you, everyone. Until next time.
Oh, thank you. So Sanlam Private Wealth, to you, Anne, and your group, and to everyone else enjoying the call. Have a great afternoon.